So you want to learn how to invest. Maybe you heard it's a good time to buy right now, but you don't actually know a whole lot about investing. Well, today I'm going to show you the most important things I know about dividend investing, and hopefully by the end of this video and in a week's time, you're going to know more about investing than the vast majority of everybody in America. Pretty much anybody who doesn't watch this video. And like always, if at any time in this video I say something or describe an example that you don't quite understand, pause the video, go to Investopedia, search the word that I said that you don't understand, or go to YouTube and search it and watch a video or two, read some articles over it, and then come back and continue watching this video. This might sound tedious and boring, but it's the best way to learn, because in order to learn anything, you have to first be able to understand the words. I know it sounds tedious, but just pause the video, go learn the word, come back and continue the video. All right, let's get started. All right, first thing you're gonna wanna do is download M1 Finance and Webull. There'll be a link in the description below. You get 10 free dollars on M1 Finance. And if your initial deposit on Webull is $100, you could get up to $1,400 in 2 free stocks. So the first thing to know about investing in the stock market is 3 pillars of investing. That is fundamental analysis, technical analysis, also called price action, and qualitative analysis. Some people vow that only technical analysis works, while others say that only fundamental analysis works. Some people only use qualitative analysis. My recommendation is you learn all 3. The way I look at this is, let's say you wanted to become an auto mechanic, and you walk into the first day of your class, and the teacher hands you a socket wrench, and you go, nah, whoa, no, I only use open head wrenches, or I only use adjustable wrenches. If that's your mentality coming into something, I mean, yes, this will work, but there's the right tool for the right job. And that's the way I look at 3 pillars of investing. The only person who's gonna suffer from not knowing how to use one of these tools is you. So in this video, we're gonna cover all 3 of those and how you can apply them to long-term investing. Now, before we begin, I need to talk about mindset. So I could sit down for 6 months straight and teach someone everything I know about technical analysis, or everything I know about fundamental analysis or qualitative analysis. I could have them read as many books as they want over the numbers and the graphs and stuff, but that will not make them a good investor. The difference between a good investor and the average person is an investor actually thinks differently. But there is an investor mindset. For example, let's say you wanted to become a chess grandmaster. Well, you're gonna have to first learn how to think like a chess player to become good at chess. Now, naturally, you would just do that as you do it, but that's not really the case for investing. The fastest way I found to rewrite how you think and how you view investments is to actually read the most popular books on investing in the world. If you haven't seen it yet, I have a video called What Happened When I Read 50 Books Over Money. If you click on the description of that video and drop down, all 50 books are there, and then I've got a must-read list, and the majority of those books are investment books. I highly recommend you read all of those books over the next couple weeks, and you will again be light years ahead of the majority of people when it comes to investing. These books are written by the most successful investors in the past 100 years. You are literally diving into their minds to understand how they think and how they process things. And by understanding their minds and understanding how they do things, it will help you emulate those same things so that you can become a successful investor. And the second thing that I need to talk about before we begin is risk. So there is a tremendous amount of risk when it comes to investing, especially in the stock market. As all of you know right now, a lot of people are losing a lot of money right now. So there is always inherently a lot of risk that comes into this. Here's a list of the top 10 risks that you're going to be facing when it comes to investing, and that's whether you're investing in real estate or the stock market or any other venture. Now, for the stock market, I highly recommend you research Dunning-Kruger effect. That's a very important one to learn. That's probably the biggest risk starting out in the stock market. You're going to be overly confident coming into the stock market. Almost everybody is. And then I also highly recommend researching market risk and concentration risk, or a lack of diversification. Again, there's a link in the description over the top 10 risks, and you can read more about them down there. We're going to talk about them a little bit here and there in this video, but it would take an entire video just to go through all the types of risks. All right, let's get to the fun stuff. So we're gonna jump over here to M1 Finance. This is my current portfolio that I'm working on. It's lost about 18%, which is about 10% better than the stock market currently. So this is actually the perfect time to shoot this video, because we are actually in the middle of a stock market crash. The virus outbreak is happening, and we usually only get crashes every 5 to 10 years. So this is the perfect time to shoot this video so that I can explain to you the entire market cycle. So whenever you're studying the stock market, the overall economy of any country goes through a cycle. Every country has their own cycle. They're going through things at different times. So the US market might be doing really well and through a really good boom, while maybe another country is in a complete depression. recession. A good example of this would have been Greece and the financial collapse of Greece a few years ago. And the reason that's important is because there's certain parts of the stock market that will perform better depending on where we are at in that cycle. If you would like to learn more about that cycle, I highly recommend going and watching this video. It's by Ray Dalio. He is one of the best investors in the world and runs one of the best financial institutions in the world, and he is also one of the best-selling authors in the world for personal finance and personal development. He has a book called Principles and the book Big Debt Crisis, which explains market cycles. Highly recommend you read that book. Now, let's jump over to this website. This is actually fidelity.com, and you can actually see the business cycles here. So we have early, mid, late, and recession. We are currently in the late cycle. We're pretty much hitting recession now. This crash in the market could turn into a recession if we don't get the economy back to work. But if you look down here, you will see that there are sectors to the market, and these sectors will perform better or worse depending on what point we're in. So right now, companies that I wouldn't say are doing well. No one. It's a common misconception that there's companies that will actually do really well in a recession. Usually they just break even or they don't lose money because there's so much contraction happening in the market that it's really hard to perform well during a recession. But these sectors that do perform really well are consumer staples and healthcare and typically utilities. So consumer staples there's defensive consumer staples and there's cyclical consumer staples. We'll cover that later. But defensive ones would be like Walgreens, Costco's, any kind of pharmacy, anything that people go to and spend money at no matter what the situation is. Estee Lauder is a really good one because women are always going to buy makeup. Okay, let's jump back over to M1 Finance, and you'll notice in my portfolio that I have US market, bonds, precious metals, non-US hedges, inflation, and volatility. Now, you might be wondering what hedges are. Hedges are very important. There's a lot of YouTubers out there teaching investing and stuff, but none of them cover hedges. Hedges is like pinnacle of the most important thing you can understand when it comes to protecting your money. A lot of people ask me how to get into investing or how to get into day trading. My typical answer, if they ask me what's the most important thing to focus on, it's not make money. Everybody thinks coming into the stock market is to make money. The number one thing in the stock market is don't lose the money you have. For every 10% of loss you make, you have to regain 20%. If you lose 50%, you have to make 100% back. So the number one rule in the stock market is do not lose money. If you're putting money in, don't lose it. And that is what hedges do. The second rule is make money. So let's take a look at inflation hedge real quick, because I think this one is going to be a really good example of a good hedge, because you can see it's up 3.47% already. While everything else is crashing, this is actually going up. And I'll explain how it's going up in a second. So we have in this pie 3 indexes. So we have TIPS, SHAP, and SPIP. And each one's allocated 34%, and they're all about doing the same. Now, if you would like to make your own portfolio, I'll show you how to do that real quick. I'm going to have a link in the description of this specific portfolio, so you can see it, and you can even add these pies into your own portfolio if you want to. But if you want to make your own pie, you can go to Research, My Pies, Create Pie, and then just type in whatever index or whatever stock you want and add it to that pie, name it, and then you can add it into your portfolio and allocate it. I'm not going to go through all that. Plenty of videos on the internet to do that. Just search M1 Finance how to. All right, so back to inflation. We are making almost 3.5% while everything else is crashing. Why is this? Well, this chart, this is why I don't like just fundamental analysis or just quantitative analysis, because price action and technical analysis can show you a tremendous amount of information in situations like we're in right now. Now, over long periods of time, technical analysis can break down, can be used if used correctly and used right. Just like this wrench, there's a time and place to use an adjustable, there's a time and place to use a socket and a flathead. There. So let's jump over to this website. This is tradingview.com. If you just type in tradingview.com, it'll bring you to this website. You can type in SPY here at the top for ticker. This will come up, hit full featured, and you'll get a screen something like this. Now we're going to edit this real quick. Go to settings. I'm going to drop down this background color, and I'm going to give you a very quick rundown on what technical analysis is. So what we're looking at right now, this is the 5-minute chart, and these are candlesticks. They're actually called Chinese candlesticks. The reason they're called Chinese candlesticks is because they were actually invented in the 1600s. Chinese rice farmers used to go and trade and sell their rice at markets, and what they would do when they would go to the market in the morning, They would write down the opening price of what the rice was, and then throughout the day, they would track the lowest price that it was sold at and the highest price that it was sold at. And then at the end of the day, when all the markets closed down and everybody went home for the day, they would write down the closing price of whatever they sold. And this is represented visually here. So each bar you're seeing is, if you're looking at a green bar, the bottom is the open, the top is the close, and then you see these little, they're called wicks here. These wicks are the high and low prices. Now, I'm not gonna get into anything more about the candlesticks than that. I'll put a link, or there'll be a video explaining, if you wanna learn a lot more about candlesticks. I do recommend you study candlestick patterns. Specifically, the ones you wanna look for are flag patterns, continuation wedges, bullish engulfing candlesticks, and dojis. Those are the 4 most important ones that I would recommend you start with. Let me give you a rundown real quick, because technical analysis can intimidate a lot of people. You know, if Chinese rice farmers from the 1600s can figure this stuff out, and they did this, you can figure this out. This is not nearly as complicated or as intimidating as it looks. So what price action is and what technical analysis is a visual representation of the masses and their opinion on any one stock or any given index. That's it. There, a lot of people think about the stock market as like the matrix, and there's numbers and calculations and computers and stuff. There is all that, but at the core of it, it's just people. It's just a visual representation of what people are thinking. Okay, so let me set you up real quick. We're gonna go ahead and go up here and click to the 1 week chart. So this is a representation of 1 week's worth of, so real quick, I'm gonna change the lines and stuff. Okay, so what we're looking at, every candlestick is 1 week worth of price movement. You can change your charts to look at different time periods. I would just recommend sticking to weekly charts or daily charts. If you're doing long-term investing, you don't need to mess with like 4-hour charts or 1-hour charts or 5-minute charts. That's more for trading and day trading. But for long-term trading, it's very nice. And I'm gonna give you 3 indicators that are fantastic to use when it comes to long-term investing. What you wanna do is go up to indicators and then type in moving average. You want to click this one, and then you want to type in exponential move, and you'll click on move average exponential. Add 2 of those, actually add 3 of those. Okay, so then you're going to come over here to this arrow, click it, and here's all your move averages. The first one, which is MA, you want to edit that real quick, go over to input. We're going to change this to 200 and make it golden, and then we're going to make it a little bit thick because this one is a very important move average. So we're making it 3 times. Now the remainder is gonna be 13 EMA, which will make white. We're gonna drop that down to like half opacity. Hit okay. We're gonna make this one light blue. We're gonna make that a 50. And we'll up that bar to a 2. And then the last one, we are going to make a 4 EMA. And we're gonna make this one yellow. And we're gonna drop that to half opacity. So what we've just done is move averages. Each one has a little bit of a different calculation. The MA is different than the EMA, but they all essentially work the same. What they do is they look back X number of bars and they give you an average price of whatever that is. That's what the line represents. And you can use these to measure trends and calculate if something is overbought or oversold. So when it comes to investing and putting money into something, the worst thing you can do is buy something that's oversold or overbought. For those of you who study real estate or know anything about real estate, there's a theme in real estate that you always make your money on the buy. When you go into a deal, you should know how much money you're making profit from the get-go, from the start, and you should have that in equity pretty quickly. If you're doing a renovation or something, you can make money that way. When it comes to the stock market, the worst thing you can do is put money into something that is overextended or overbought. And there's a few ways that you can do that with technical analysis. I'm also going to edit the volume bars real quick just so it's a little bit easier to see. All right, so what I'm going to explain now is, like I said earlier, in my portfolio, that inflation is doing better than the overall market. So what we're going to do is we're going to add all of these hedges into the charting platform. And I'm going to show you visually how you can use these charts to figure out what's going on and gauge what's happening in the market. And then you can use this information to make better decisions when you're buying stuff, because that's really what technical analysis is. If you're doing long-term investing, you're probably doing a buy and hold strategy. It's also called dollar cost averaging. The idea is you just throw money into it and you never pull it out. You never sell. And that can work really fine. But there are times in the market when things happen that you can get a much better price on your investment just by waiting a day or two or knowing how to read these charts. So what we're going to do over here on the right side is type in SPY, which is the S&P 500. We're going to type in GLD, which is gold, SLV, which is silver, and then we're going to do SHY, IEI, TLT, and then IEF, and drag that one above TLT. Then we're going to add TIP and VXX. All of these are indexes. They either track a bunch of companies or they track like a precious metal like gold and silver. SHY is the 1 to 3 year treasury bonds. IEI is 3 to 7 years. IEF is 7 to 10 years. TLT is 20 years. Now TIPS is a index that is weighted with inflation. So when inflation rises, this will rise. And this is a very good index to have in your portfolio right now, and I'll explain that in a minute. VXX is volatility. Now volatility, if you are trying to do a passive portfolio and you don't plan on managing this actively a year from now or 2 years from now, I would recommend not messing with volatility hedges, because as you can see, this chart is it's a decaying chart. If I go back to February 2016, this chart has almost lost 96% of its value. The reason, I'm not gonna get into why that happens, but volatility hedges should only be used by people that are actively handling and managing their money on a daily basis or a weekly basis, because any money you put into it is going to be lost. It is essentially, it's like insurance, kind of. Actually, that's a perfect example. It is insurance. You're essentially, if you allocate maybe like 3% of your portfolio to volatility, you can expect to lose all of that money within a 1 to 5 year period. You're going to have to like put money into that to maintain it, but on the downside, any losses that you take from it is going to reduce your overall portfolio's performance. So again, don't recommend it for people that are trying to passively invest and not actively managing their portfolio. But if you are actively managing your portfolio, it can be a fantastic tool if you stay on top of it. Let's take a look at TIPS. TIPS is my inflation hedge, and we're gonna switch this to the daily chart so that I can show you a little bit better. And we're gonna pull up another chart. So I'm gonna come over here and I'm gonna go to Fed assets. So this chart will be linked in the description. This is a very important chart to watch and look at. This is essentially the US government and how much money they are spending to buy up stuff in assets in the market. They call it quantitative easing and a whole bunch of other stuff. What they're really doing is they're printing money and they're buying stuff. Now that might not always be the case. They might be using tax dollars sometimes. For the most part, when the feds buy stuff, you should expect inflation to be rising. And that's exactly what has been happening. So the US Federal Reserve is printing money and giving it out as stimulus packages and trying to maintain and keep the economy afloat. Flip side on this is inflation is going to be rising. Now, let's compare this chart to the S&P 500. So we're going to click on SPY. You'll see that the SPY, and if you hold down shift and click, you can drag and measure the exact percentages of what we're moving. And you'll notice that if I go back to TIPS, if I just flip back and forth here, you'll notice that TIPS fell originally. TIPS came down while the market was crashing. Now, why is this? Why would this happen if inflation is going to be rising? Well, because the Feds didn't start printing money yet. So if you Google Fed rate meeting, this is the Feds, and typically they have meetings scheduled every, I think, 4 quarters in the year, and they typically evaluate interest rates and some other things, and they decide what they're going to do. They held an emergency meeting a couple weeks ago and said they were going to be printing money and creating a stimulus package. And if you go over to the asset, you'll see that this huge spike up right here, this was March 11th. Go back to the TIPS chart, scroll over here to March 13th. This is when it stabilized and it rebounded back up, and now it's continuing long. So TIPS, inflation, this is a very nice hedge to have in your portfolio. Now let's take a look at the SPY. So the SPY is the top 500 companies in the U.S. stock market. It's called the S&P 500. There's a bunch of different indexes. There's the Russell's 2000, and there's even a low cap one, and you can find indexes for anything. And we're going to get into more indexes in a minute. And the thing to know about indexes is they are the average. So let's talk about some other hedges. So we have precious metal hedge, which is it's only down 7%, and I've already explained volatility, and then we have non-US hedges. Now, if I open up my non-US portfolio, I actually have 50%, well, actually it should be 50%. Currently it's at 46%, but I have international bonds, which is bonds, and bonds are a very good hedge too. If we go back to my main portfolio, I have bonds here, and here we see the TLT, IEI, and SHY. These are the federal bonds. Typically during recessions and market crashes, bonds typically hold up very well. Whenever you start reading the investment books that I told you about, you'll notice that a lot of them recommend having anywhere from 25 to even 75% of their portfolio in bonds, depending on the situation. I would not recommend 75% of bonds. There's better inflation tools to use, like inflation and gold, than bonds. But old school style investing back in the 1950s and stuff, bonds were a very popular thing, and they still are. Now, if we go back over to the SHY, which is the 3-year, you'll notice that it has been climbing over the past couple of weeks. TLT has also been climbing. IEF. Now, the reason for this, and if we also go over to gold and silver, you'll notice gold had a pullback and now it's coming back up. So, when you visualize the US stock market, when people panic, they pull their money out of the stock market, and they either do a few things. They hold it in cash, they invest it in gold or silver, or they invest it into an inflation hedge, or they invested into bonds. The reason that gold and silver is popular is because gold and silver is actually the oldest form of currency that has ever existed. We've been mining gold and silver for over 10,000 years. There's only a finite amount in the crust, so it's not like money where you can print more and inflation causes it. So gold has always been something that humans just psychologically are attracted to and find value in it. There's no real reason for it. Humans have loved gold for tens of thousands of years. For some reason, it's just something that we find value in, and therefore people put money into it typically whenever they panic or get scared. All right, now let's take a look at the US market. So if I open this up, I have it split between late recession and early mid. This is attached to this chart right here. So this is a Fidelity website. Again, link will be in the description. And here you see market cycle. So we have early, mid, late recession. We're currently in between late and recession, and you'll see down here that we have all the sectors, and most of these sectors will typically perform better in certain points of a market cycle. If we go back to my portfolio, you'll notice that 75% of my US market is actually late recession and only 25% is early mid. We click into early mid, you can see communication, real estate, technology, all these other ones. And these percentages aren't accurate because I rebalanced and sold some stuff and changed around my portfolio. So unfortunately, those numbers are not correct. But we go to late recession and we have healthcare, consumer defensive, utilities, energy, and materials. And then if we open these up, each one, you'll see that I have this thing in here, the XPL. So this is, again, it's an index, it's a fund. This is actually a fund that tracks the consumer staple defensive sector. I'm going to explain in a little bit how to fundamentally analyze stocks, but for newbies, for people that are brand new starting out, I highly recommend that you use funds in all of your portfolios. I have a fund in every single one of my pies. So if I click on healthcare, I have the XLV, which is the healthcare fund. I have utilities, which has the XLU. Funds are the average of whatever it's looking at. The reason it's important to use these when you're starting out is because, like I said earlier, one of the biggest risks is the Dunning-Kruger effect in investing, where you think you know more than you do, and that can cause you to lose a lot of money. Funds protect you from the Dunning-Kruger effect because they give you an average. If you think you're going to come into the stock market and you're just going to pick all your own stocks and stuff, there's a really good chance that you're going to lose money if you don't know what you're doing. Funds protect you from yourself. So I highly recommend, the less you know about the stock market, the more you should use funds. If you feel really intimidated by evaluating stocks and technical analysis, I would recommend even having up to 75% of all of your portfolio or more as funds. You can even do 100%. If you don't want to mess with individual companies, there's no reason you have to. You can completely do it with funds. If you do it with funds, you can actually manage your portfolio in a way that I'm going to show you in a minute. All right, so let's now move on to fundamental analysis. So we're going to analyze a company that I'm currently invested in. Let's do Walgreens, WBA. So you want to go over to seekingalpha.com, type in WBA at the top, and this is the homepage you're going to see. The first thing you'll notice is you got PE ratio of 7.8, which is pretty good. But what we're going to look at first is dividends. So one thing I haven't explained yet is there's different types of stocks you can invest in. There's regular stocks and there's dividend stocks. The best way to explain this is a normal stock is essentially like if you would buy a house and the house appreciates with value. A dividend stock is where you buy a house and then you rent out that house and you make profit off of it. Dividend yield, this number right here, is a ratio based on the price of the stock. So when a price of a stock drops and gets cheaper, the dividend ratio goes up. When the price of the stock goes up, the dividend ratio will go down. A good dividend ratio is 3 to 4%. A bad dividend ratio is typically under 2.5%. And if a company has a dividend ratio above 5% or 6% or higher, it typically can be seen as a dangerous stock. Just because it has a high dividend ratio does not mean that it's a good company. The next one you want to pay attention to is payout ratio. Payout ratio is a percentage of the profits used to pay dividend holders. So when a company makes money every month or every year, after they pay off all their debts, all of their expenses, they have money left over as profit, and then a percentage of that, which is payout ratio, is given to the shareholders as profit. Now, dividend stocks aren't that great when you first buy them. You're only going to be making about 4% on your money. However, like buying a house and renting it out, let's say you buy a house and your monthly mortgage is $700. You're paying $700 a month for the bill, but you're renting it out for $1,000. So you're making $300 profit. That's pretty good, but let's say 10 years down the road, the house is appreciated, so it's gained even more value. That's on the equity side. That's not what we're talking about right now. But let's say the rent is probably going to increase. So the rent is now going to be at $1,500 or maybe even $2,000 if it's a really good property in a good location. So your mortgage payment is still $700. So by doing nothing, you are now making more money per month off of your investment. And that's the nice thing about dividends. So you won't make a lot of money off of them in the first year, but 5 years down the road, 10 years down the road, 20 years down the road, you can make a tremendous amount of money because the amount that they're going to be paying you and the amount of money that they're generating and earning is going to be much higher. So the next thing we want to look at is dividend growth. This is kind of a visual representation of what I've just explained. So this is how much they pay per share, and you can see that this is increasing year over year. So a good company will increase their dividends every year because they want to attract more investors and they want their investors to stay with them. So they're going to give them more money as they earn more money and make more money. If you look at this chart and it's going down or it's jaggedy like this, that can be a sign of an unstable company or a company that you might not want to invest in. Now we're going to switch over to key data. We're going to keep this really simple. We're going to go to filing or financials and income statement. We want to look at gross profit and operating income. We just want to see that it's increasing year over year or at least staying the same. You don't want to see a drop in income. That means they're losing business and stuff like that. If we go over to balance sheet, this is the one that I look at much more intensively. This is the one that I focus on a lot. In times like now, when we're having a stock market crash and companies are laying off employees and stuff, these companies need revenue and they need income to pay their debt. And you can find out what their debt is and their asset ratio in this chart or in this screen. So what we're going to be looking at is total current assets, total current liabilities, and total liabilities. You see current on this chart, that's anything that has been bought or sold or due in a 1 year period. Total current liabilities is debt due within this year. And then total liabilities is debt due at a longer date. The first numbers that I look at is total assets to total liabilities. And this is actually can be done in a ratio. And again, this is why ratios are fantastic in investing, because you can use a ratio and compare it and contrast to every other company. One thing I would recommend doing is when you're evaluating companies, you always want to evaluate the same ones in a sector. So we're looking at Walgreens right now. You would want to compare Walgreens to CVS and then some other companies, which I'll show you how to do in a minute. But you want to write down any of these ratios that you find important and compare them across the companies. So we're going to take the total current liability, or the total liabilities, which is $66,493, divided by the total assets, which is $90,807, which gives us 0.73 debt to assets ratio. What this means is 73% of their total assets could be sold off and pay off their debt. What this means is if we fall into a massive recession or a massive depression, and there is a real risk that companies can go insolvent and go bankrupt. One of the big 10 risks of investing is companies can go bankrupt in recessions. And companies that balance their books well and they handle their assets and their debt ratios well are much more likely to survive a depression and a recession than ones that don't. The higher that ratio is, if that ratio starts reaching a 1-to-1 or a higher than 1, it means they have more debt than they do assets to pay off their debts. And that's a very dangerous place to be during a recession. So the lower this number is, the better. A company that has a really good debt to asset ratio is Activision Blizzard. This is a video game company. They make Overwatch and Call of Duty. They have a debt to equity, or a debt to asset ratio of 35%. Or 0.35. And if you think about this is a video game company. Their assets are franchises and brands and software. They don't own a whole lot of physical products. They don't own a lot of infrastructure. They don't own a lot of buildings, whereas Walgreens is a old school brick and mortar franchise where you have to have a store location, which means you have property taxes and property, and there's a lot more overhead there. So different sectors, again, will have better or worse ratios, and you want to compare and contrast. But let's jump back to Walgreens. The next thing you want to pay attention to is total current liabilities to total liabilities. So this ratio will tell you, how much of their debt is due within a 1-year period. Now you can either compare current liabilities, the 1-year liabilities, to total assets or 1-year assets, or you can compare 1-year liabilities to total liabilities. It doesn't really matter which way you do it, just do it the same way every single time. So you'll see here that total current liabilities is $29,000 out of the $66,000. So half of their debt is due within 1 year. What I'm going to do is compare $29,494 to the total assets of $990,000, which gives us a ratio of 32%. So if they completely shut down and they have to start selling off assets, 32% of it will be sold just to pay off this year's debt. So that's a ratio you want to pay attention to. The next one would be total equity and total common equity. Research the two and understand what they're doing. And again, like I said, if you don't understand any one of these words, highly recommend you go to Investopedia and read about it. A lot of these ratios, actually everything on this sheet is on Investopedia. You can learn everything about this if you want to. I've gone through, and it takes quite a while. This is more like how to learn to invest in a month or two. But you should learn all of these brackets, because this is the nitty gritty of long-term investing. This stuff, I weigh fundamental analysis much heavier for long-term investing than technical analysis. Technical analysis is good for dip buys and getting good prices. So let me show you that real quick. I didn't show that. Let's just go back to the SPY. So let's say you were just investing in the SPY. So if you were doing a dollar cost average, buying into the SPY, every week you throw in $50 or $100 or $200, whatever. And you just kind of get an average. Now, that 4 EMA that we added in there earlier, you could essentially look at that as your price in the stock market, or where you're putting in money if you're doing it every week or every day. If you pay attention to technical analysis and you start to learn patterns and charting, you'll notice that stocks will run up and they'll come down and they'll bounce. And a lot of times they'll bounce off this blue line, which is the 50 EMA. So you can have a strategy of, let's say you invest $100 a week into your portfolio no matter what. But let's say you're also building up a cash reserve on the side, which you should do if you handle your own money in an effective way. So let's say you're dumping $100 every week, and then all of a sudden you see the stock market pull back and touch the 50 EMA. and you've got $500 just laying around that you want to invest. You can throw, because you understand technical analysis and you're able to read these charts and see a good dip buy, you can put money into this when it comes down and touches the 50, so you get a better price. So that's how you use technical analysis to get better prices on the investments that you're handling. Now, if we go what we were just looking at is the monthly chart. This is the weekly chart. You can see it much better on this way. So anytime it comes down and touches the 50 EMA, you're essentially getting a price. If we scroll here, every one of these bars is a week. And if you're putting in money here higher, but then all of a sudden it drops down and you can buy it at a cheaper price. So why wouldn't you do that? That's why you should use technical analysis. It shouldn't be your staple of investing for long term, but fantastic to get dip buys if you're doing a buy and hold strategy. All right, back to Walgreens. So equity is typically what's left over after all debts are paid. So that's another quick way to evaluate what would be left over for a company after, like if it totally collapsed and had to close its doors for a while. The downside is that's not a ratio. And the reason you use ratios is because it's much easier to compare and contrast a small company to a big company, which leads us to the next thing. How do you compare companies? If you go over here to Seeking Alpha and you click peers, look here, you have Walgreens, CVS, 3M, and Cardinal Health. You can now scroll down and go through all of these statistics, and you can compare and contrast the companies and what you feel is important. Now, the things that I would recommend you focus on is return on equity and return on assets. Those are very good, important ratios to understand and learn. Go to Investopedia, read about them, watch some videos about them. You also want to look at revenue growth year over year. That's basically, how much is the revenue increasing every year. And then again, you can, here's another nice one. You can compare dividend information against each other. And then lastly, what you don't want to focus on is returns. So 1 month return, 1 year return, 3 year return, 5 year return. You never want to, that's price action. That you should analyze that stuff on technical analysis. So returns, I can gather much more information just by clicking over here. If I just click and go to Walgreens, scroll back, and if I just look at this monthly chart, I can tell if this is a good company just by this chart. So this company has been growing month after month continuously. It's gotten hammered lately, but anytime you see a technical chart that is just like this over a 10-year period or a 20-year period, there's a really good chance that it's going to be a good company. So you can actually quick and dirty evaluate a company and its performance and if it's a good company based on this chart alone. And you don't really want to pay attention to the price action. You want to pay attention to that big yellow line. When that yellow line is stable and steady like this, it's a good company. Now, if that yellow line is like this or it's like this, it's probably not a good company. But again, when it comes to total returns and stuff, use technical analysis to evaluate returns. Don't mix, because returns is price action. It's and if you don't understand what price action is, just YouTube that. It's essentially technical analysis, but you don't want to mix price action with fundamentals. Like if you're trying to evaluate fundamentals, focus on the fundamentals. Don't focus on the price action. So another important stuff is earnings per share, diluted, and then you have total debt to equity, and then current ratio and quick ratio. Recommend you learn about those, and book value per share. And yeah, that's about it. Now I'm going to show you one more website. So I've explained that the importance of fundamental analysis is comparing and contrasting similar companies. And this is Y charts. This software is actually like $2,400 a year. I bought it for a much cheaper price, and I will probably end up showing a lot more of Y charts and generating you guys reports for those of you that might be interested in that. But I'm going to show you real quick what's nice about this. So this is one of the only, it's actually the only charting software I know where I can go and I can chart visually fundamental data. So I'm going to load up. All right, so we're going to do debt to cash ratio, and we're going to throw in CVS and WBA, Walgreens. So we're comparing this. So this software is really nice for doing fundamental analysis, quick and dirty, fast, because I can compare and contrast two like-minded companies and visually see it and represent it instead of trying to read numbers. And on top of that, they also have a scanning software that allows you to scan for companies in very specific ways. We won't get into that though in this video. So first off, we're looking at market cap. Market cap is how much money they totally own. You can kind of look at market cap as the total. If you hear like artificial intelligence has a $1 billion industry, that's essentially a $1 billion market cap. And then you can take that cap and break it into all the companies that exist in that market. So CVS and Walgreens, they're in the defensive consumer sector. And what you want to look at for market cap is one increasing and the other's decreasing. That means that one's taking over shares, they're taking over the market. So market cap can be a way to analyze if a company is losing market hold. And then we have debt to asset ratio. We've got Walgreens at an 18%, where CVS is at a 30%, and this is quarterly, it's not yearly. So what that means is Walgreens is actually, as far as recession-proof, Walgreens is in a better position than CVS. And then we have the debt to equity ratio. Again, CVS is at a 1, whereas what we calculated, it's a 70% right here. It's a little off based on the Seeking Alpha, but essentially right now, CVS is in a much more dangerous spot than Walgreens as far as paying off their debt if they start to lose revenue. And I'm losing my voice. And then again, we have the cash ratio, which I'm not going to explain any of that because this video is already getting pretty long. There you have it. That's a quick rundown of fundamental analysis, technical analysis, how you can use it when investing. You learn all three, which we haven't talked about qualitative analysis, but I'm just going to brief over it because it's pretty self-explanatory. Qualitative analysis is evaluating a company based on its business model, based on its products, based on its ethos, what it believes in, what it's trying to accomplish, 5-year plan for the future, 10-year plan for the future. Qualitative analysis is also, what kind of sales model do they have? What kind of infrastructure do they use? How do they distribute? What is their competitors? What is their suppliers? Is their sales model old school, or is it more new school, like multi-level marketing? All that. So all that stuff is important. Now, the last thing that I want to talk about for long-term investing that is almost never covered in any of the videos that I see is taxes. You've seen my video, what I learned reading 50 books in 5 months. First thing I talk about is taxes. Pay income tax, you're going to be broke. You're going to stay middle class forever. The biggest difference between rich people and poor people, or middle class people, rich people understand how to not pay taxes. When it comes to investing, taxes is one of the most important things to understand because the government is really good at getting your money. Now, if you have a 401k or a Roth IRA or even a stock portfolio, you're going to be taxed no matter what. So Roth IRAs are called tax deferred, which means the taxes moved off to a later date, which sounds like a great thing, but it actually might not be based on some statistics and stuff that's coming out. As of now, taxes typically increase over time, and inflation is causing wages to go down, which means your money's not going to go as far as it would and longer. We're not going to get into it. Then there's capital gains, which is 15%. So if you have a standard portfolio, if you make profit, this is why you don't want to sell. If you make profit on an investment in the stock market, you're going to be paying capital gains when you sell that stock. There's little ways you can move around taxes that way. So let's say you have one company that's going up really high, but you want to get out of it. Let's say it's like overextended and you think that it's way too overpriced, like Tesla, for example. If you make a bunch of money on Tesla and then you sold at the top, you're going to pay capital gains on that at a 15% rate. However, let's say you've made an investment that lost a lot of money. But let's say it's a long-term hold. Let's say you plan on this company turning it around in the next 5 years or 10 years. At the end of the year, you can actually sell the loss position, which will, you write that loss off and you don't pay capital gains on the money you made. And then like January 3rd, you just buy back into that position because you're holding it for long term and you've offset your losses. So that's just one little trick on like getting around taxes when it comes to capital gains and stuff. Taxes is super important, and I highly recommend you go watch my video, 50 books on money. Now, the last thing I want to talk about is actually the best long-term investment asset that I've ever learned about. I actually just recently learned about this. You're going to be seeing this a lot more in my YouTube and my channel. I'm losing my voice. I have just started working with a company called PHP Agency. It's People Helping People. It's a life insurance agency, and they sell one of the best investment assets I've ever heard of or learned. It's actually called the rich man's 401k, or the rich man's Roth. And what these are called is indexed annuities. If you want to learn more about them, just go Google indexed annuities. I'm not going to explain it in this video. But they are by far the best long-term investment that you can get in because they gain with the S&P 500 on the market, but when the market crashes like it is now, you lose no money, 0% loss. And it is such a fantastic asset to own that so many people don't understand or even know exists, that I'm going to be making a lot more videos on this. But it's better than a Roth, it's better than a 401k. It is tax-free. The government cannot touch it. You don't pay taxes at the end of your life with it. You don't pay taxes when you're putting money into it. It's completely tax-free, so it's already better than a Roth and an IRA or a regular portfolio because you don't pay any taxes. And the next best thing about it is it's liquid. So a 401k or a Roth, you're going to get a huge penalty. You're going to lose almost 40% of your money if you pull out money before your retirement. So they're essentially illiquid. You can't use them for emergencies like what's happening right now. A indexed annuity, you can actually loan money to yourself from your death penalty and use that to pay your bills off and stuff if you're struggling for a year or two. And you don't have to worry about that. And on top of that, it also has a death penalty. So if you die, your parent or your spouse or your kids get money. So we'll talk a lot more about indexed annuities. It's one of the best investment platforms that exists. It's way better than everything I've just shown you, and it's way easier, but this video is already getting too long. So I hope you enjoyed this video. Please like and subscribe, and please share these videos. If you guys enjoyed these videos, I'm trying to build up my YouTube channel and really get this thing rolling, and sharing these videos helps out tremendously. You guys built this YouTube channel by sharing it. If you'd like to ask me questions or pick my brain, please send your questions to Instagram. I actually am and have been doing a lot more live videos and posting on stories, answering questions and stuff. So hit me up there. And I'm about to be moving to Austin, Texas. So if you live in Austin, hit me up. Would love to meet you. And I'm going to be building my own team and expanding my network massively in the next year or two, especially with this company that I'm working with. So if you're interested in working with me and making a lot of money, hit me up. My mentor, I don't know if he allowed me to say this, but mentors above him, which I'm also getting coached by, they've been doing this for 5 years and they're making over $1 million a year. So if you're hungry and you like to work hard and you really want to learn investing in money and finance, hit me up and let me know, because I would love to work with you.
Carl Jung has suggested that all personal problems are relevant to society, and that any sufficiently profound solution to a personal problem may, if communicated, reduce the likelihood of that problem existing in anyone else's experience in the future.